This is the Southside School of Financial Freedom Watchlist and Market Report for the week ending September 24th, 2022. Our question this week is, what is demand destruction? The answer will be provided later in the video. This week, the market ended lower. The Dow Jones Industrial Average decreased minus 1.62% on Friday and was down minus 4.0% for the week. The S&P 500 decreased minus 1.72% on Friday and was down minus 4.65% for the week. The Nasdaq decreased minus 1.8% on Friday and was down minus 5.07% for the week. Looking at the week, we can see that there were 12 down finishes versus 3 up finishes for the major indexes. On Monday, all the major indexes finished up. However, on Tuesday, Wednesday, Thursday, and Friday, they all finished down. The new unemployment claims were 213,000. Existing home sales fell 0.4% in August. Home builder sentiment in September fell 3 points to 46. Gold hit a 2-year low. Bond yields soared during the week, and the Fed raised interest rates by another 0.75 percentage point. New unemployment claims, existing home sales falling, home builder sentiment dropping, gold hitting a 2-year low, bond yields soaring, and the Fed hiking interest rates another 0.75 percentage point are all news. And news drives the market, good and bad. Day-to-day predictions on whether the market is going to go up or down are virtually impossible because predicting the news is impossible. However, the market is rigged to go up. It does not go up every day or even every week, but the market will generally go up over time. Stock prices move in a random fashion. They go up and down with an upward drift. The market will go up for as long as the powers that be want the market to go up. While there are many powers out there, the top 5 powers that be are the Federal Reserve, big financial institutions, big corporations, the President, and Congress. These 5 entities will do what they must to drive the market higher. Now, we are at our question of the week. What is demand destruction? In economics, demand destruction is when the price of a commodity, good, or service becomes so high that a permanent and or sustained decline in demand for that item occurs. Consumers decide that the item's price is so high that it is not worth purchasing the item anymore, or at least not purchasing as much of it. Demand destruction is usually brought on by inflation, that is, high prices. However, the Federal Reserve, by raising interest rates, may bring on a general demand destruction by making the cost of borrowing money too high. Goods like autos and real estate that normally require consumers to borrow money to purchase may experience demand destruction due to the high cost of borrowing. Even lower dollar items like food and consumer goods may also experience demand destruction because consumers stop using credit cards to make purchases. And of course, the demand for stocks can also be destroyed by the Fed's higher interest rates. Has higher interest rates destroyed the demand for your stocks? Or do you own any stocks at all? If not, why not? Is it because you do not understand anything about the stock market? Well, it was not taught to you in school. However, if you ever want to learn how to get wealth and income through the stock market, you are going to have to teach yourself. You must RSI, that is, read, save, and invest. Formal school taught you how to read, but society and the powers that be discourages you from reading, especially books. School taught you to be a worker. They did not teach you how to be an investor, and they taught you absolutely nothing about the U.S. financial system. You can learn how to be an investor if you simply start reading books about investing. Books that you can borrow from the library for free or buy cheaply online. It is not difficult to learn how to be a passive investor, which is what most people should do. Check out this list of recommended books on the books page of the Southside website. These books and others like them will not tell you which direction the market is going to go, but you can learn how to make money in the market no matter what the market does. I don't know which way the market is going to go on a daily basis, and I don't care. I trade the market as it is, not as it should be. I take what the market gives me, whether it's going up, down, or even sideways. How do I do that? I apply the Southside strategy. You can learn more about the Southside trading strategy at southsideschooloffinancialfreedom.com. Here is the Southside trading watch list from the week ending September 24th, 2022. The strongest performer on the list this week is Shares ETF, ticker symbol GLD. In the first column, it decreased minus 1.73% on Friday and was down minus 1.82% for the week. Yes, it was the best performer by having the smallest decrease for the week. The Spider Gold Shares ETF offers investors a cost-efficient and secure way to assess the gold market. Gold shares represent fractional, undivided beneficial ownership interest in the trust's sole assets, which are gold bullion and, from time to time, cash. Looking at a summary of results, you can see that GLD has decreased minus 10.5% year to date. I did not generate cash flow from GLD this week, but I have generated cash flow from it in the past. Whether a stock goes up or down, you can generate cash flow from it. Whether you own a stock or not, you can still generate cash flow from it using the Southside strategy. The Southside trading strategy involves trading for weekly cash flow, that is, trading for income. SPY is shown at the bottom of the third column. SPY is the S&P 500 ETF. This is the benchmark I compare my trading performance to. My objective is to beat the S&P 500 index while at the same time generating cash flow. Most professional money managers do not consistently outperform the S&P 500 index. They usually lose and lose badly to the index. Thus, most investors and traders should just invest in or trade a market index fund or ETF like SPY. What do? Do you beat the S&P 500 index? Do you have a watch list? What is your investing and or trading strategy? How well do you do against the S&P 500 index ETF SPY? Let me know in the comments section. Are you willing to share your strategy? The Southside Portfolio cash flow system is outperforming the S&P 500 index ETF SPY. The Southside Portfolio is down minus 7.25% versus minus 22.53% down for SPY, a difference of 15.28%. The Southside is beating SPY by more than 15%. The cash flow generated by the Southside cash flow system for this week was 4.34% of the portfolio account value. The account value changed by minus 11.21%. Meanwhile, the S&P 500 ETF SPY changed by minus 4.57%. Bitcoin watch. Bitcoin lost almost 4% this past week, and it continues to be in a bear market. It is down just over minus 72% from its all-time high achieved in November 2021. I sold option contracts on one position this week. It was a put that range from $0.00 to $115.01. You can get more details, including the total dollar amount of cash flow for the week, on the website SouthsideSchoolOfFinancialFreedom.com. To increase your financial IQ and understanding of the stock market, please check out past videos for other questions of the week. The videos are organized in playlists, levels 1, 2, and 3. Level 1 being for beginners, level 2 for intermediate, and level 3 is for more advanced investors and traders. The videos are also arranged in playlists by subject matter. In the meanwhile, please like, share, and subscribe.